Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So the S&P 500 has now more or less returned to where it was around April, just before April. And the drop in April is now completely gone. A lot of the companies have recovered. But the issue is there are some companies, not issues, but there are, the good news for us is there are some companies that are still undervalued. And some sectors have not done as well as the others, so I'm currently looking at where the opportunities are, and based on what's happening in the geopolitical side of things, there are companies that potentially might be a good buys right now moving forward. So I'm going to share with you guys 5 companies that are basically undervalued at this point in time that could be potentially a good buy for your portfolios. Now, one of the things that we need to do as a long-term investors is have a diversified portfolio, unless you are new to the stock market, and in which case I would definitely advise you to look into ETFs rather than buying individual stocks, because of course the risk that's involved. If you are basically interested in individual stocks, then you should be trying to have a diversified portfolio. This is my current portfolio allocation. So I have got about 21%. So there are 11 sectors in the S&P 500. So I've got 21% in information technology. Financials is now overtaking industrials, so now about 18%. Industrials about 16%. Consumer staples is now actually overtaking the healthcare, which is quite interesting. So there's about 10% there. Healthcare is 10%, materials 10%, real estate 7%, energy 6%, and consumer discretionary about 3%. To be honest, the consumer discretionary has always been the lowest for me anyway, because I've only got one company, and that's Home Depot. Now, utilities and communications, I've not invested in any of these because the majority of the companies in there are either not a good investment or are not Sharia compliant. So I've left those two out. So this is what I'm trying to do, just kind of build a diversified portfolio. And the good news about this is, right, and we've seen this in 2022. If you have not been investing that long, go back and check what happened to the S&P 500, the information technology sector in 2022. So a lot of the tech companies were down a lot that year. Energy was the best performing basically sector that year. And then there was a couple of other sectors that done well. But if information technology was down a lot. Now that year is when I was buying more information technology, and of course it balances your portfolio. If you've got energy in that year, the energy companies will do well for you, and then of course it will balance the fact that the information technology is not doing well, and so on. This is why they always say have a diversified portfolio. And of course this allocation might be a bit too much, because 21 and 3% is basically, there's a massive difference. Okay, but for me, I feel comfortable enough to hold this. So that's for me anyway. So yours might be slightly different. So what I'm going to do today with you guys is basically talk about energy companies that have not gone up as much as the rest of the S&P 500, and basically show you where the opportunities are, inshallah. If you haven't joined us to the Patreon account or have not liked the video already, please do so. It really genuinely helps the channel. I'm just going to give you a quick overview of each one of these companies, and again, as always, please do your own research and find out a bit more information about some of these companies. And the first one we're looking at today is EOG Resources, and this is one of the companies I have in my portfolio. It's almost 66 billion market cap. All of the companies on this, by the way, have a narrow moat, which is basically the highest any company in the energy companies sector can get anyway. Current price is $125 per share, dividend over 3%. One thing you will notice about these companies is they do pay quite a bit with regards to dividends. Okay, the payout ratio is only 32%, which means they can increase that dividend if they want to over the next whatever years. Latest increase was 5%, and the 5-year growth rate is basically 28%, which is absolutely huge. The dividend streak for 7 years is 7 years. Annually you got $4.08. Dividend safety of 82%. The highest that any company can get when it comes to the dividend safety is 99%, and anything above 61 is actually safe. Profit margin, return on equity, return on invested capital is really good. free cash flow of $5.5 billion. EPS growth expected next year is about 15% in 2026, revenue growth of 14%, and right now it's undervalued about 5% according to Morningstar valuation. So it's got upside of 5%, $131 per share is where they think the price should be. Right now, as we see here, is $125 per share. If you haven't liked the video, please do so. It really genuinely helps the channel. The next one is SLB. This is again another similar sort of a company. This one is actually has a basically with regards to the dividends, they cut the dividends quite some time ago, and market caps right now 48.5, narrow mode as well, $36 per share, 3% dividend yield. The payout ratio 33%, again is very low. The latest increase was 3%, but they did cut a while ago. The dividend streak is only 3 years ago, so it's only been increased in the last 3 years. Annually you got $1.14. Dividend safety 6%. Profit margin, return on equity, return on invested capital is really good. Over $5 billion of free cash flow right now. One of the things you will notice about these companies, they do have quite a bit of free cash flow, and I say quite a bit, not huge, but at least they do have excellent free cash flow, but they do burn a lot of cash as well. Okay, EPS they're expecting to be about 7%, revenue about 4%, 40% upside from where we are right now. $51 per share is where they think the price should be. Next one is Hess Corporation. I think this is let me just actually find out. Yeah, I just wanted to double check this company was who bought the company. I think it was initially I thought it was Exxon, but it's Chevron. I'm not sure what's happening. This was about 2 years ago. I don't know if the deal hasn't gone through yet. Normally, basically, it takes quite a long time for these oil companies to acquire other businesses because of just trying to monopolize the markets and things like that. So probably the government are still looking at it. But yeah, they were expected to be bought by Chevron, so I think that deal is still on the table. Let's see what happens. 53 billion market cap, narrow mode, $142 per share right now. Dividend yield of 1.4, one of the lowest on this year and on this thing. The latest increase is 14%, the 5-year growth rate of 13%, and the dividend streak of 3 years. You get $2 for every share of this company that you own. Dividend safety is only 60%, but that's fine. 61 and above is safe. Profit margin 17%, return on equity 20%, and return on invested capital of 14%. $1.1 billion of free cash flow. They're expecting the earnings to grow almost to 40% and revenue about 16%, and 12% upside from where we are right now. $159 per share is where they think the price should be. Really an interesting company, and we'll see if that basically deal goes through. The next one is ConocoPhillips, 120 billion market cap, narrow mode as well, $96 per share. Dividend yield of 3.26%, which is really good. Payout ratio only 40%. Latest increase 34%. The 5-year growth rate of 13%, 8 years of increase in that. Annually you get $3.12. Dividend safety of 61%. Now, one of the things I like about these type of sectors, especially the real estates or the REITs, if you like, the oil companies or the energy companies, is if you are a sort of a dividend investor and you're looking for, some of those high yield companies to kind of supplement the fact that you've got low yield companies. So for example, in my situation, I've got companies like Visa and MasterCard, S&P and Global, which are my biggest holdings, right? But I also have companies like EOG Resources because of that 3.3 different dividend yield right now. And that kind of supplements my cash basically that I'm receiving every single month and helps the overall portfolio. So this is the type of thing in portfolio management you should be doing as a basically individualist stock investor, if you like. Profit margin, return on invested capital, probably one of the best out there when it comes to energy sector. Free cash flow $8.6 billion, which is probably one of the highest on this list. And EPS is about expected to grow about 12%, revenue about 4%, 14% upside from where we are. $111 per share is where they think the price should be. And finally is Canadian Natural Resources, which is another company I have in my portfolio. 69 billion market cap, narrow mode, $33 per share right now, and that dividend is the highest on this list of 5 over 5%, which is really good. The payout ratio is only 54%, so they can increase if they need to. The latest increase was 4%. The 5-year growth rate of 23%. And when we look at the dividend streak, is 23 years. So 23 years of income, basically increasing that dividend. If they were in the US and they were in the part of the S&P 500, they would have been basically in 2 years time a dividend aristocrat. Annually you get $1.70, dividend safety of 70%, which is really good. Profit margin, return on equity, return on invested capital, really good. Over $9 billion of free cash flow right now. They're expecting the earnings to basically grow 5%, revenue to grow basically about 10%, 14% upside from where we are. $38 per share is where the price is basically should be, and right now it's about 33, so $5, whatever, of that price. So again, all of them are undervalued at this point in time. They do have excellent free cash flow. They will give you dividends and so on at the same time, and they are very profitable businesses. So this is the type of companies that I like to own in my portfolio, but not more than 4% or so probably about 2-3% to kind of supplement my basically low yielding companies, and then hold them for a long time and hope that the price will go up. Top of that, you get the dividends, which you can reinvest in this type of business. Again, this is the beauty of basically trying to manage your own portfolio. You have to think about all of these things. You're not just going to buy the high flyers on their own and just leave this type of sector. You need to have a diversified portfolio, and that's what I'm trying to do. So a lot of these basically almost this 40% of my portfolio is in basically these two sectors, and these two sectors do not pay huge dividends. Okay, but I need to use the basic consumer staples, the healthcares and the materials, real estates and energies to kind of supplement that cash flow, if you like. Now, final thing I want to show you is the Sharia compliance side of things. You can pause the video. None of them have a huge problem other than basically SLB. I would say basically you have to be careful with that one. And again, it's still under that 33% that we're normally looking for when it comes to the standards that we use. Anyway, that's what I want to share with you guys. If you're enjoying this type of content, of course join us in the Patreon account where you get access to a lot of things, including the buys and sales and things that I normally make. And of course the Discord is free now, so I'll put the link on the description. I'm sorry, I think I messed up the link recently, so it's a lot of people messaging me saying they can't find it, but it should be on the basically on the description section of this video, so you can basically join wonderful brothers who are sharing very good practices on daily basis. Anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.